Forex Fundamentals and Trading. Chapter 8. Trading Sessions and Market Timing. Section 1. London Session. The London session matters because it sits at the center of global Forex activity. A very large share of daily currency turnover passes through London, which means prices discovered there often influence the rest of the trading day. It also connects the end of Asia with the start of North America, so order flow from different regions can meet in one place. That creates deeper participation from banks, funds, corporations, and other large institutions. For a trader, that usually means more meaningful movement, better liquidity, and levels that the market tends to respect. In practical terms, if you want to understand where the day may gain structure, London is often the first place to look. One detail that catches many traders off guard is that London does not stay at the same UTC time all year. During standard time, the London session runs from 08:00 to 17:00 UTC, but during daylight saving time, it shifts to 07:00 to 16:00 to 16:00. That 1 hour change matters because your chart routine, your overlap windows, and your news planning can all become misaligned if you forget it. The shift usually happens from late March to late October, but you should always confirm the exact dates. Many trading mistakes that seem like strategy problems are really timing problems caused by a clock change. So before planning entries around the London Open, make sure you know what London time means in UTC and in your own local time. Activity inside the London session is not evenly distributed from start to finish. The Open often brings a burst of repricing as fresh European orders hit the market, and that can feel fast, noisy, and a little uneven. After that first wave, conditions often settle into something more organized, with price action becoming easier to read. Mid-session can offer a better balance between movement and stability, especially for traders who do not want the chaos of the Open. Then, liquidity often strengthens again when New York joins, creating one of the most active windows of the day. This is why time within the session matters almost as much as the session itself. A trader who treats all London hours the same may end up using the right idea at the wrong moment. The London-New York overlap is often the strongest trading window in Forex. Roughly between 13:00 and 16:00 UTC, two of the largest financial centers are active at the same time, and that tends to produce the deepest liquidity of the day. In many cases, spreads are tighter and execution is smoother because there are more participants on both sides of the market. Major pairs like Euro/USD and GBP/USD may also show cleaner breakouts because volume is strong enough to push price through key levels with more conviction. That does not mean every move is easy, but it often means the market is more responsive and less thin. For many active traders, this overlap is the period they build their routine around. While London is open, European-linked pairs usually attract the most attention. EURUSD and GBP/ESD are obvious leaders because they combine heavy institutional interest with strong regional relevance. EURUSHJPY is often active as well, especially when European flows meet broader risk sentiment. USD/CHF can also trade efficiently during these hours because the Swiss franc is closely tied to European market behavior. More broadly, Euro, Pound, and Franc pairs often show better movement and tighter conditions when London is active. This does not mean other pairs stop trading, but these instruments are often where the clearest session-specific opportunities appear. If you are selecting what to watch during London, starting with these pairs is usually sensible. London hours often include important UK and Eurozone economic releases, and those reports can move price very quickly. Data such as UK inflation, employment, growth, Eurozone GDP, or Eurozone inflation can all shift expectations for interest rates and economic strength. When the actual number differs meaningfully from forecast, the market often reprices in seconds rather than minutes. That can create sharp directional moves, but it can also widen spreads and make entries harder to execute cleanly. This is especially important for traders in pound and euro pairs, where the reaction can be immediate. A setup that looked calm a minute before the release can become completely different once the number comes out. So checking the economic calendar is not optional during London hours. It is part of basic risk control. The London session often follows a rhythm that becomes easier to recognize with experience. At the open, the market is frequently busy with repricing and fresh order flow, so early movement can be sharp and less stable. Before scheduled news, price sometimes pauses and consolidates as traders wait for information. In the 10, 0 to 13, 0 to UT window, trends often begin to develop more clearly as the market digests the early session and picks a direction. Later, as London moves toward the close, volume often fades and the market can lose some of its earlier momentum. Understanding this rhythm helps you avoid reacting to every candle as if it means the same thing. The same price pattern can behave very differently depending on whether it appears at the open, before news, or late in the session. Consider a simple example in GBP/USD around a UK GDP release. Before the data, price is sitting quietly near 128.28, which tells us the market is waiting rather than committing. Then GDP comes in at 0.4% instead of the 0.2% expected, and that upside surprise quickly strengthens the pound. GBP/USD jumps from about 1.285 to 1.285 to 1.2840 almost immediately as traders reprice the outlook. After that first spike, the market pauses, which is common because early buyers take profits and late participants decide whether to join. If the underlying surprise is strong enough, momentum can rebuild and price may extend higher, in this example toward 128.80. The lesson is that news moves often unfold in phases: the initial shock, the pause, and then the more orderly continuation. The London session offers strong opportunity, but it also invites a few common mistakes. One is assuming liquidity stays high and stable all day, when in reality conditions change from the open to the overlap to the close. Another is forgetting daylight saving changes and showing up an hour early or late for the best window. Traders also get into trouble by trading GBP pairs without checking whether important UK data is due. A related mistake is holding normal size positions through major releases without adjusting for wider spreads and faster moves. The theme behind all of these errors is lack of preparation. London rewards activity, but it rewards planning even more. The main idea to keep in mind is that London often offers one of the best trading windows in Forex, but activity alone is not the edge. The edge comes from understanding when liquidity is strongest, which pairs are most active, and how news can change the character of the market. Session phase matters too, because the open, the mid-session period, and the New York overlap can feel very different. Time changes also matter more than many beginners expect, especially when converting London hours into UTC or local time. If you approach London with a plan instead of just excitement, the session becomes much easier to use well. That prepares us nicely for the other major half of the day, the New York session. Section 2. New York session. New York hours matter because the US dollar sits at the center of the Forex market. The session runs from 8:00 a.m. to 5:00 p.m. Eastern Time, but the busiest part is usually the morning, especially from 8:00 a.m. to 12:00 a.m. to 12:00 p.m. During that period, New York overlaps with London, so participation is often especially heavy. It is also the time when many major US economic releases hit the market, which can create strong movement in dollar pairs. Because USD is involved in so many transactions, what happens in New York often affects much more than just one or two instruments. For traders, that means this session is not only active, but often decisive. Activity during New York hours is driven by both participation and information. In the morning, US and European traders are active together, which gives the market a lot of depth and energy. At the same time, important US data often arrives, including labor, inflation, growth, or consumer reports, and these numbers can quickly shift expectations. Fed announcements or comments can have an even larger effect because they change how traders think about future interest rates. Capital flows into or out of dollar assets also matter, especially in pairs where USD is the key driver. So New York movement is not random noise. It is usually tied to a mix of fresh information and large financial participation. That is why price action in this session often feels purposeful, even when it is volatile. The New York session has its own rhythm and timing matters a great deal. The open at 8:00 a.m. Eastern often brings an immediate burst of activity as traders position for the day. From about 8:30 to 10:00 a.m., the market enters an important data window. since many major US releases are scheduled there. This is usually the most eventful part of the morning, and price can move very quickly if the numbers surprise. From the open through around noon, liquidity is often strongest because London is still active for much of that period. After noon, conditions often begin to slow, and the market may become less reliable for short-term momentum trading. A trader who understands this rhythm is less likely to confuse an afternoon drift with a true morning opportunity. The first half of the New York session often provides the best conditions for active trading. Liquidity is usually deepest early, especially while London is still open, and that often leads to tighter spreads and faster execution. Those conditions can support breakouts and trend continuation because there is enough participation to carry price forward after the initial move. This does not guarantee success, but it tends to create a better environment for short-term strategies than the later part of the day. Traders who focus on clean fills and follow-through often prefer this morning window for that reason. In practice, it is one of the times when the market can offer both movement and efficiency together. That combination is a big part of what makes the New York morning so important. Later in the New York day, conditions often begin to change noticeably. As European participation fades, volume can drop, especially from around 12:00 p.m. to 2:00 p.m. Eastern. A market that was trending earlier may start to consolidate, stall, or become choppier. Spreads can widen again in the late afternoon, and short-term price action may become less dependable. This does not mean nothing happens later in the day, but the quality of movement often changes. Without a fresh catalyst, the market may simply drift rather than trend. For many traders, that is a signal to become more selective rather than keep trading out of habit. New York hours matter most for pairs that respond strongly to US news and dollar flows. Euro/USD is highly active during the overlap because it combines heavy European and US participation. GBP/USD can also react sharply to US data, even when the news is not directly about the UK, simply because the dollar side of the pair is so influential. USD, JPY, and USD/CAD are also closely watched in New York, with USD/CAD especially sensitive to North American themes. Some emerging market currencies can become more active as well when US risk sentiment or dollar demand shifts. So if your focus is the New York session, it makes sense to watch instruments where USD is likely to be the dominant force. Those are usually the pairs where session timing has the clearest effect. Imagine Euro/USD trading around 1:085 just before a payrolls release. The report comes out at 250.30 jobs versus 108.300 expected, which is much stronger than forecast and tends to support the US dollar. Because Euro/USD is quoted with the euro first and dollar second, stronger USD pressure usually pushes the pair lower. In this example, price drops quickly to 1.078 within about a minute and a half, showing how violent the first move after major data can be. But the first move is not always the easiest one to trade well. A rebound back toward 1.0800 can create a more controlled short entry area once the initial shock settles. This is a common pattern in New York news trading. Sharp reaction first, cleaner opportunity after the first burst. The deeper lesson from that example is that entry timing can matter as much as market direction. Major data can create immediate volatility, but the first reaction is often messy and emotionally difficult to chase. Traders who jump into the initial spike may face slippage, poor fills, or a fast pullback against them. Waiting for a retest or a more structured pause can reduce that whipsaw risk. In the New York morning, strong liquidity often helps the market continue after that pullback if the underlying news really changed expectations. So the idea is not just to predict direction, but to choose a moment when the trade is easier to manage. Good timing turns a correct view into a usable setup. A useful exercise is to observe the New York Open rather than trade it right away. First, convert New York hours into your local time so you know exactly when the active window begins for you. Then, watch a pair like USD/CAD on a 15-minute chart starting around 8:25 a.m. Eastern, just before the common 8:30 release window. Record the release price and the next 3 candles, paying attention to total range, candle size, and whether the first move holds. Repeat that over 3 different days and compare what you see with the same pair during Asia. This helps train your eye to notice how much more dynamic the New York morning can be. It is a simple habit, but it builds timing awareness much faster than memorizing session facts. Many New York timing mistakes come from assuming the session behaves the same from open to close. High volatility usually does not last all day, so traders who expect a morning pace in the afternoon often force bad trades. Another mistake is entering without checking the economic calendar, especially when major US data may be only minutes away. Time conversion errors also matter, because a trader using the wrong local equivalent can completely miss the best window. Holding positions into the close without a plan is another common problem, since liquidity and behavior can change late in the day. The broader point is that session awareness is part of risk management, not just market trivia. Understanding when New York is favorable helps you decide when not to trade as much as when to trade. Section 3. Asian Session. The Asian session is usually the calmest part of the Forex day, but it still plays an important role. It typically runs from about 00 to 0900 GMT, with Tokyo as the main financial center. As the session develops, Hong Kong and Singapore add more participation and improve liquidity. Sydney contributes earlier in the cycle, but its influence tends to fade by the session close. Even though this period is often quieter than London or New York, it can establish key highs, lows, and range boundaries that matter later. In that sense, the Asian session often sets the stage rather than delivering the whole story. Traders who ignore it may miss the levels that London reacts to. Price behavior in the Asian session is often different from what traders see later in the day. Volatility is usually lower, ranges tend to be smaller, and trends often take longer to develop. Even when the market moves early, that move may lose momentum as the session continues, especially if liquidity is still thin. This does not mean the session is untradeable. It means expectations should be adjusted. A strategy built for sharp London breakouts may feel out of place in a quieter Tokyo environment. The pace is slower, and follow-through is often less reliable unless there is a clear catalyst. Recognizing that difference helps a trader stop forcing one session's style onto another. Because the Asian session is often quieter, many traders focus on strategies that reward patience and structure. Range trading near support and resistance can fit well when price is not moving far or fast. Some traders also use this period to prepare for a possible breakout later, especially if the market spends Asia building a tight consolidation. Scheduled data from Japan or Australia can create tradable bursts of movement, but even then, confirmation matters. In lighter liquidity, weak moves can look stronger than they really are. That is why waiting for a level to hold, or for a breakout to prove itself, is often wiser than chasing the first push. The session tends to reward discipline more than urgency. The pairs that are usually most active in Asia are linked to Japan and the broader Asia-Pacific region. Yen pairs often lead the session, with USD/JPY usually at the center of attention. EUR/JPY and GBP/JPY and GBP/JPY can also move well, especially when broader market sentiment affects demand for the yen. AUD/SEE is another important pair because Australian data and Reserve Bank expectations can move it during these hours. This means the Asian session is not just quiet in a general sense, it is selectively active in certain instruments. If you are watching pairs that naturally belong to this region, the session can offer cleaner opportunities than many traders expect. Pair selection matters even more when overall volatility is lower. Japan and Australia matter because their data and central bank communication can quickly change price behavior during Asian hours. Japanese releases can move yen pairs sharply, especially when they affect inflation, growth, or policy expectations. Comments from the Bank of Japan can be even more influential because the yen is highly sensitive to shifts in rate outlook and intervention concerns. Australian data can do something similar for the Australian dollar, particularly in AUD, USD, and related crosses. Remarks from the Reserve Bank of Australia also matter, especially when the market is trying to judge future policy direction. During a quieter session, one important release can stand out even more than it would later in the day. That is why the calendar remains essential, even when the session seems calm overall. The Asian session usually unfolds in stages rather than one continuous flow. Around 0000 GMT, Tokyo opens and yen pairs often become more active. From roughly 0100 to 03 GMT, Japanese data can provide the main catalysts for movement. Between 0300 and 0600 GMT, liquidity often improves as more regional centers are active, and this middle part of the session can feel more orderly. After 0600 GMT, activity often slows again as the market begins waiting for Europe. This changing rhythm matters because a setup that works in the middle of the session may be less reliable very late in it. Many traders reduce exposure before London arrives for exactly that reason. One of the most common traps in the Asian session is the false breakout. Because liquidity can be thinner, an early push through support or resistance may look meaningful even when there is not enough participation to sustain it. Price can break a key level, attract breakout traders, and then quickly reverse back into the range. When London opens and deeper liquidity arrives, the market may completely reprice that earlier move. This is why confirmation matters so much in Asia. Instead of treating the first break as truth, it is often better to wait for a close beyond the level or for the move to hold as liquidity improves. In a quieter session, patience is often better protection than speed. Take the example of a Japan CPI surprise pushing USD JPY below 110.00. The data beats forecast, so the initial logic makes sense. Stronger inflation may support the yen, and USD JPY falls from 110.20 to 199.80. A trader sells the break at 199.95, expecting continuation lower. But because the move happens in wider session conditions, the breakout does not hold. Price later rebounds above 110.00 and reaches 110.10, stopping the trader out. The lesson is not that the data was irrelevant, but that the first move after news was less reliable because liquidity was still limited. In Asia, even a correct idea often needs confirmation before it becomes a good trade. A practical way to learn this session is to review it systematically on the chart. Start by marking the Asian session high and low, because those levels often matter later when Europe opens. Note when each extreme occurred, since an early session high can mean something different from a late session high. Measure the total range in pips so you can judge whether the session was quiet, normal, or unusually active. Then compare that range with several recent Asian sessions to build a sense of what is typical for that pair. If the session was larger than normal, ask whether news from Japan or Australia explains the difference. This kind of review helps connect timing, volatility, and catalysts in a way that random chart watching does not. The Asian session can feel safe because it is often calmer, but that feeling can create bad habits. One common mistake is trusting every breakout, even though thinner liquidity makes false breaks more likely. Another is ignoring the economic calendar, especially when Japan or Australia has scheduled releases that can still move the market sharply. Using too much leverage is also risky, because a small session range can tempt traders to oversize positions. Some traders choose illiquid pairs at the wrong time and end up paying wider spreads than they expected. Stops placed too close are another problem, since even a modest fluctuation can knock the trade out before the real move develops. Calm conditions do not remove risk. They just change what the risks look like. Section 4. Session Overlaps. A session overlap happens when two major trading centers are open at the same time. In Forex, that shared window often creates some of the most active conditions of the day because more participants are trading at once. With more banks, funds, and other market actors involved, trading volume usually increases. That often improves liquidity and can make price action feel more tradable. Levels may break more cleanly, spreads may tighten, and moves may carry further than they do in a quieter session. Of course, more activity also means more speed. So an overlap is not just busier, it is often a different trading environment altogether. Overlaps matter because rising participation tends to improve some market conditions while making others more demanding. On the positive side, liquidity usually improves and spreads often narrow, which can help with execution. Price movement also tends to become more responsive, so breakouts and directional moves may follow through more clearly. But that same increase in activity means moves can happen faster, and reactions to news can become much stronger. In other words, the overlap can offer better opportunity and higher pressure at the same time. This is why traders often like overlaps, but also why they need a plan before entering them. Good conditions do not remove the need for discipline. They make discipline more important. The most important overlap in Forex is the London-New York overlap. London runs roughly from 08:00 to 17:00 UTC, and New York runs roughly from 13:00 to 22:00 UTC. So the overlap is about 13:00 to 17:00 UTC. This is a key window because it brings together the two largest Forex centers in the world. When both are active, order flow is often at its heaviest and the market has its deepest participation. That is why many traders view this period as the busiest and often the most useful part of the day. It is where European trends may continue, reverse, or accelerate once US traders join. If a trader learns only one overlap well, this is usually the one to study first. As the overlap begins, traders often notice a shift in the market's character. Conditions that felt quieter beforehand may become more responsive once both centers are active. Spreads can tighten, momentum often becomes stronger, and breakouts may occur more often because there's enough volume behind them. Prices also tend to react more quickly to incoming data, especially if US releases are involved. This change can feel positive for execution, but it also means indecision gets punished faster. A weak setup that drifted harmlessly before the overlap can fail quickly once activity increases. Recognizing that transition helps you adjust both expectations and risk. News can amplify overlap conditions dramatically because many important US releases arrive during this window. When surprise data hits a market that is already busy, price can move sharply in a very short time. Liquidity may be good, but the experience does not always feel calm because many traders are reacting at once. That can create crowded moves, faster pricing, and temporary spikes in volatility or spreads. This is why checking the economic calendar before the overlap is essential. A trade entered just before a major report is not the same as a trade entered in a quiet period with no scheduled catalyst. During the overlap, news can turn a good environment into a very demanding one almost instantly. Overlap times are often quoted in UTC, so converting them correctly into your own local time is an important skill. Start with the UTC session hours, then translate them into your local clock rather than guessing. Do not rely only on broker platform time, because brokers may use a different server time that does not match your local reference. You also need to recheck everything when daylight saving changes occur, since London and New York do not always shift at the same moment in the calendar. A 1-hour error can easily cause you to miss the best part of the overlap or trade when you think the overlap has started, but it has not. Many timing problems come from poor conversion rather than poor analysis. Accurate time translation is part of trading preparation, not just administration. Overlap periods often suit faster styles of trading, but they are not ideal for every strategy. Breakout trading can fit well because price is more likely to push through key levels with real participation behind the move. Momentum trading can also work better when increased activity helps trends extend. Short-term scalping may benefit from tighter spreads and quicker price response, although it also demands sharp execution and discipline. On the other hand, slow and very stable setups may not fit as naturally when the market is moving more quickly. This is why strategy should match environment. A trader does better by using the overlap for what it naturally offers instead of forcing a calm session approach into a fast session window. More activity creates more opportunity, but it also creates more risk. Better liquidity can improve execution, yet faster movement can also increase slippage and make stops easier to hit. Emotional mistakes become more likely when the market is moving quickly and reacting to news. That is why smaller position size can make sense during overlap periods, especially if volatility is above normal. Stops also need more thought, because placing them casually in a high activity window often leads to frustration. Another important habit is reviewing positions near 17:00 UTC when London is closing and market behavior can begin to change. Opportunity is real during overlaps, but risk control has to rise with it. Imagine Euros USD sitting in a tight 10 pip range at 14:30 UTC during the overlap while traders wait for US retail sales. The market expects 0.4%, but the result comes in at 0.8%, a much stronger reading than forecast. That surprise supports the dollar, and Euros USD drops about 35 pips in 2 minutes. A trader who entered before the release might get caught in the noise or even stopped out by the violent first reaction. A more patient trader may wait for the initial burst to settle, then look for confirmation on a lower high or a failed rebound. That second entry is often clearer because the market has already shown its direction and absorbed the shock. The example reminds us that in overlap trading, being right about the news is useful, but being patient about the entry is often what makes the trade workable. A simple observation exercise can make overlap behavior much easier to understand. Record the Euro/USD spread at 12:45 UTC before the overlap is fully active, and then record it again at 13:15 UTC. Track the session high and low between 13:00 and 17:000 and 17:00 UTC so you can see how much movement the overlap actually produced. After 17:0 UTC, compare spreads and price activity again once London has closed. This gives you a direct before, during, and after view of how conditions change. Add a note about whether any economic releases occurred, since news may explain part of the difference. Over time, this kind of observation builds practical timing awareness instead of just theoretical knowledge. Overlap periods are useful, but they are easy to mishandle when traders focus only on excitement. One mistake is treating overlap conditions like a normal session, even though the pace and risk are often very different. Another is confusing UTC, local time, and broker time, which can put you in the wrong window entirely. Using too much leverage around news is especially dangerous because fast moves can overwhelm a position very quickly. Holding trades too long after London closes is also risky, since the character of the market often changes once one major center leaves. Some traders also chase moves without paying attention to structure or handoff effects between sessions. The best way to use overlaps well is to treat them as high opportunity periods that demand high preparation. Section 5. Volatility timing. Volatility timing means choosing when to trade based on how much movement the market is likely to offer. In Forex, the hour of the day often shapes behavior because different sessions bring different levels of participation and different catalysts. High volatility usually means faster and larger price moves, which can help breakout or momentum traders. Low volatility usually means narrower ranges and slower movement, which may suit range-based approaches better. So timing is not just about convenience, it is part of strategy selection. A setup that makes sense in a fast market may be poor in a quiet one, and the reverse is also true. Volatility timing helps you align your method with the market environment instead of fighting it. Volatility changes when the market has a stronger reason to move or when more traders are active at once. Economic data can trigger sharper pricing because it changes expectations about growth, inflation, or policy. Central bank announcements do the same on a larger scale because interest rates matter so much in Forex. Major market opens, especially London and New York, also tend to raise activity because volume increases. Session overlaps often push volatility even higher for the same reason. So volatility is not random background noise. It usually reflects either new information or stronger participation. Once you understand what tends to raise volatility, it becomes easier to anticipate when conditions may change. Different sessions have different trading personalities, and that helps explain why volatility is not constant through the day. The London-New York overlap, roughly 13:00 to 16:00 UTC, is often the most active period because it combines the two largest Forex centers. During that window, USD, Euro, and GBP pairs often show stronger movement and cleaner responses to news. By contrast, the Asian session is usually quieter overall, even though JPY, AUD, and NZD pairs can still become active around regional catalysts. Knowing this helps set realistic expectations before you open a chart. If you expect overlap-style movement during a quiet Asian range, you will probably force trades that do not fit the environment. Volatility timing begins with accepting that sessions naturally behave differently. Market timing works best when your strategy fits the session rather than fighting it. High volatility conditions often suit breakout setups because price has enough energy to move through levels and continue. Low volatility conditions often suit range trades because support and resistance are more likely to contain price. But the key point is that support and resistance still matter in both environments. Volatility timing does not replace analysis. It helps you decide which type of analysis has the best chance of working. A good trader is not just asking where price might move, but also whether the current session gives that idea room to work. Matching strategy to session is often a simple change that improves consistency. Volatility is also a risk management tool, not just a trade filter. The same setup may require a wider stop in a fast market because normal price swings are larger. If the stop needs to be wider, position size usually has to be smaller to keep total dollar risk the same. In a quieter market, price may move less, so a tighter stop can make sense, and position size can sometimes be larger. Profit targets should also reflect expected movement, because aiming for a huge target in a low volatility session may be unrealistic. This is why copying the same stop and target into every session is a mistake. Good risk management adapts to how much the market is actually moving. One practical way to measure conditions is with average true range, or ATR. ATR estimates how much price has been moving on average, and importantly, it measures size of movement rather than direction. A simple approach is to use a 14-period ATR on a 1-hour chart and compare it with a recent 20-hour average. If current ATR is around 1.5 times that average, volatility is meaningfully above normal. If the reading is lower than recent norms, the market is probably quieter. This does not tell you whether price will go up or down, but it does tell you what kind of environment you are dealing with. That makes ATR a useful tool for deciding whether a breakout setup, a range trade, or no trade at all makes sense. A simple routine can turn volatility timing into a repeatable habit. Start by mapping the major session times into your local clock so you know when conditions are likely to change. Before important opens or overlaps, check ATR or another volatility measure to see whether the market is quieter or more active than usual. Then choose between a breakout approach, a range approach, or no trade if conditions are poor. After entry, keep reassessing, because volatility can shift quickly as sessions hand off or news approaches. This process is simple, but it helps prevent trading on autopilot. It also reminds you that waiting is sometimes the correct decision when the environment does not support your setup. Consider Euro USD just before the London-New York overlap. On the 1-hour chart, current ATR is 12 pips versus a recent 20-hour average of 10 pips, which suggests activity is above normal but not extreme. Price is pressing against resistance near 1,050, so a breakout idea becomes reasonable because the environment may support expansion. A trader plans the entry at 110.50, with a stop loss at 110.30, giving the trade enough room to breathe. Because volatility is a little elevated, position size is reduced to half a lot rather than using a full-size trade. This is a good example of volatility timing working with structure rather than replacing it. The setup still depends on resistance, but ATR helps shape the risk and the expectation. In this example, the trade does move in the right direction, rising to 110.85 within 2 hours. So the directional idea was correct, and the timing into the overlap helped support the move. But a US release is due at 13:30 UTC, and that changes the risk picture immediately. Instead of holding and hoping, the trader exits early and books 35 pips. Soon after, price drops 50 pips in 10 minutes, as news-driven volatility reshapes the market. The lesson is that being right about direction is not enough if the environment is about to change. Good volatility timing includes knowing when not to stay in the trade. Volatility timing is helpful, but it becomes dangerous when traders use it without context. Holding through news without checking the calendar is one of the most common mistakes, because conditions can change instantly. Using the same stop in every session is another error, since a stop that fits Asia may be far too tight for the overlap. Quiet markets are not always safer either, because low volatility can still produce sudden expansion. Traders also misread a brief spike as a lasting condition, when sometimes it is only a temporary burst. And perhaps the biggest mistake is treating volatility alone as the whole strategy. Volatility is a filter and a risk guide, but it works best when combined with structure, timing, and discipline.